Initial public offerings. I was complaining last week that my producer Natasha Jacobs is snorkeling with my kop in a manner of speaking by bringing up topics that make me go, what? IPOs, what are they? Well, the best person to speak to about that is Noah Greenhill. He's the head of marketing and business development on the Johannesburg Stock Exchange. Noah, nice to have you in the studio.
Thanks, Jeremy.
Now, what is it? If somebody comes up to me and says, I've got an IPO for you, what should I be looking for?
So an IPO is when a company decides they're going to come and list on the Johannesburg Stock Exchange. And an IPO stands for initial public offering. So it is an offer to the public to buy shares in that specific company.
Okay. Now, let's go back a few steps now.
No problem.
Firstly, why would a company choose to go onto an exchange?
So, Jeremy, the first and foremost reason that a company decides to list is to raise capital. Okay. So let's look at the evolution of a business. I start a business, whatever it is, and I fund it with my own money.
Right.
I then decide it's getting bigger and bigger. I better go to the bank and I secure an overdraft debt.
Okay.
Okay. I grow even bigger. Now I decide, well, now I need bigger money to take my business to the next level. Now I've got lots, well, not lots, but a few options. I can go to what you would call an angel funder. An angel funder, by definition, would be an individual with lots of money who's prepared to fund a startup or growing business.
Okay.
You can go venture capital, you can go private equity, or you can come to the Johannesburg Stock Exchange in South Africa. All of those come with differing issues. But that's the evolution of a business in
Okay.
untheoretical
But
sense.
Let's go through those four then and,
Right.
and look at the different issues. Angel funder.
Okay, so angel funding, private equity, venture capital, you could probably clump together
Okay.
as a grouping.
Right.
And the issue there is that, of course, they're taking all the risk. They're saying to you, I'm giving you a lot of money. Mm-hmm. I'm going to want a huge percentage of the shares in your business,
Right.
and I want it cheap. Mm-hmm. So, in order for you to take your business to the next level, you've got to sell me your shares at a very cheap price and a significant amount of them.
Okay.
You're also accountable to one person. Now, that one person, if I own a percentage of your business, I'm going to want to know pretty much regularly what you're doing, how you're doing it, who your customers are, who your suppliers are, where you're buying your pencils from. Nothing wrong with that. It does instill discipline because, of course, the angel funder and or private equity fund coming into the business does bring a lot of positive things. They do bulk up your board. They do instill discipline in the procurement process, in the corporate governance space, which you might not have as a true entrepreneur.
Yeah.
All good things. Of course, they invest to exit at a point.
Okay.
And it's at that point often that the public markets become very attractive because now the ability to raise large amounts of money become a lot easier on the JSE.
Okay, so now you've run out of, this business is getting bigger and bigger and bigger, you're employing more people, you've got more overheads,
That's right.
angel investor has said, I'm out of here because I'm not going to plow any more money into this. So I come to you.
Right.
And I knock on your door. Noah, I want to talk to you.
Right.
And after you've said, bugger off, Mansfield, I come back to you. What is the process there?
So Jeremy, what we like to do is we like to get an understanding of the business. Why do you want to list? Because a listing, in my view, is a strategic decision that a company takes. Now, often, in the past, we have what you would term hot IPO periods. We all know them. You can kind of define them. 2006, 2007, 98, 99, just prior to the mid-80s. lots of those so-called hot IPO periods. Now, the problem with hot IPO periods is that a company thinks that because he did it, and he's in the same sector as me, and he's in the same kind of business as me, and I know the guy, and they don't know how to run a business. And those guys managed to list and raise 200 million rand, and now they've got a market cap of R1 billion. Jeez, I can do that. Mm-hmm. No real thought put into why they want to go to the market, what the listing is going to do for them, what the investment value proposition is for that business. Often, the Me Too type businesses are the ones that fail. The guys that understand what the value proposition is in listing, and that could be as a fundamental rationale raising capital, it could be profile. Fact is, who do you interview regularly on a program like this on CNBC? It's the CEOs, CFOs, IR professionals of the listed companies.
Yeah.
Who do we invest in? Who are our pension funds invested in? It's the listed companies. So at the end of the day, the quality of those companies coming through needs to be of a certain standard and stature. But you can't underestimate and you can't put a price on profile. Because salespeople in any organization, doesn't matter what they're selling, who do they go to first? The listed companies. Why? Because you can go and research what they're about, who they are, who the CEO is, what the board looks like. So much easier.
Why do you get these hot sort of IPO listing periods? What brings? There must be something. There must be something happening in the market that drives people to go and list on the exchange.
So it's those cycles. The market moves. So when you could argue when things are overbought and too hot, often you call that the end of the cycle. I personally hate the term boom, these IPO booms. You often read about booms, and the problem with booms is they are naturally followed by a bust. Now, when you look at 2006, 2007, and you look at the nature of the businesses, they weren't all in the same sector. They weren't all necessarily of the same size. They weren't all necessarily of the same quality. Why they all came at that time, who knows? Jeremy, it amazes me. Not a month ago, 2 months ago, there or thereabouts, we haven't had, last year we listed 14 companies. This year I think we've listed 5 or 6 so far, 2 of which happened on the same day. How does that work?
No, that's also a bit doff.
But you've got to understand, it's separate, 2 separate sets of advisors, 2 separate sets of documents. It just amazes me that you don't have listings, and then all of a sudden 2 companies want to list on one day. Now, of course, in media parlance, you look at that and you go, sure, 2 companies one day, woof, what's going on? Mm-hmm. Wow, must be a boom. But it's not. It's just pure coincidence. I don't know what drives. It could be.
But no, hang on. Surely that's good for you, though. I mean, the exchange is obvious. Surely the exchange is wanting people to list.
Oh, absolutely. Absolutely. One of my prime responsibilities is to go out there and find companies that are in a space that they could list. Now, challenge is, to find those guys is not very easy. So we've got to go and find them, and then we've got to go and sell them on the benefits and responsibilities of being listed. Because it's not all easy in listing a business. There are huge responsibilities in migrating from a public company to from a private company to a public company.
Well, I mean, firstly, you've got a whole lot of people who are up your nose.
Correct. Private companies,
you can do what you want. It's not good.
So regulation, if you look at the regulation between private and public, Companies Act applies private or public. The Income Tax Act applies private or public. The Code on Corporate Governance, which is not legislation, applies whether you're public or private. The takeover code, which governs mergers and acquisitions, applies whether you're public or private. And the Competition Commission applies whether you're public or private. We add the listing requirements. What we also add is the public domain. So if you and I are directors of a private company and I make a mistake, we sit down in the boardroom and you slap me over the knuckles and you tell me, don't do that again because that wasn't the way we operate a business here. And that's it, it's over. In the public domain, the reality is you're in the public domain. The media get hold of it. The JSE want to know what's going on. A whole host of other regulators in your sector may want to know what's going on. That's a big fundamental difference.
If we're in the private business together as well, though, and we decide we've had a good year to pay each other a dividend, we can do that.
You can do that. You can do that in a public company as well.
Yeah, but the difference is I found out about it in the business day. I read the director's
Correct.
transactions.
Correct.
So,
well, absolutely. Yeah.
So everyone knows what I'm doing with my shares in that company.
That's right. That's right. But again, you've got to look at the benefits. Were you able to raise capital to accelerate the growth of your business from stumbling along to really fast growth? Was the fact that you listed, did it enhance your profile? All of a sudden, were your suppliers prepared to supply you on better terms? Were your bankers prepared to engage with you on better terms? Were you able to attract better staff because you're listed? Because you could incentivize, motivate, and retain those guys with shares. Those are all huge. You can't measure those benefits to being listed. And were you able to take advantage of acquisitions in the marketplace that you might not have been able to take advantage of had you not been listed?
Okay, so that's the company side of it.
Yep.
How you get to migrate to an exchange.
Yep.
I want to now, in the next half of the program, look at me as an investor on the stock exchange, investing in that company. What are my risks when I go and buy shares on the JSE? Because if you're getting something back, there's got to be a risk to it. That's the way I think.